Okay, good morning. Today we're starting chapter 12. We only have 2 weeks left, so we're going to start right into it. Final exam is finals week. It covers chapters 9 through 13. It only covers the learning objectives that we've discussed in class. Any learning objectives that I've ruled out, like for example, chapter 12, there's no learning objective 4. Learning objective 4 is not in the practice exam. It is not in study plan, so it's already been removed. Final exam starts at 9 a.m. Monday, May 4th, and has to be finished by 12:30 on Friday, May 7th. Meaning it has to be submitted by 12:30. If you start the exam at noon on Friday, you are only going to have till 12:30. It will automatically end at 12:30. So plan accordingly. If you're in sections 5 and 6, so if you take the exams in ProctorU, please schedule your exam with ProctorU as soon as possible. ProctorU during finals week has thousands and thousands of students across the country taking finals, so you want to make sure you get the best selection of times to take it. If you don't schedule and you wait to try to take it like Thursday, there's going to be a long wait time till they get back to you. So this is the one time that it's really important to schedule ahead of time. We have a question out there in Learning Catalytics. Publicly traded companies have the option to produce audited financial statements. Is that true or false? We did this last week. Okay, so publicly traded companies have the option to produce audited financial statements. True or false? Emphasis there on option. If you're publicly traded, do you have the option to produce audited financial statements? That would be false, okay? I think right now we were at what percentage, right? 94%, so that should climb to 100 hopefully. I will say this morning in my early class, this is my late class, but in my early class this morning, for the first time ever, we got 100% right on a question. It was this one. I mean, so hopefully this class can do the same thing. It was just, yeah, we felt like we should have a drum roll when we closed at 100%. Okay, so what are we at right now? 98. Okay, so anyways, so that'll be open for a few minutes. Oh, okay, so Saturday, chapter 12 homework is due, pretty normal week. The thing that's not normal about this week is Wednesday. If you're in sections 1 or 2, I'm asking if you could please come to class in person. On Wednesday, we're going to do course evaluations, and the only way that you can do a course evaluation if you're in sections 1 and 2 is to come to class in person. If you're in sections 5 or 6, your course evaluation is on Flashline. I urge you to complete that. But I want your feedback. I've asked the university several times if we could do course evaluations for sections 1 and 2 online as well, and they've turned me down every time because we're very rigid as a university, and if you're a face-to-face class, you're going to have the evaluation in class. So I'm asking if you're in sections 1 and 2, if you could come to class on Wednesday to fill out the evaluation. We'll have the evaluation in the last latter part of class. That is the evaluation day. If you're in sections 5 and 6, you do it online, and if you are in 5 and 6 and you're here in class, you don't have to fill it out in person. But that's the only thing about this flexible format. The university is not flexible about evaluations. So that's Wednesday. So just know that's coming. If you could come to class in person, I know a lot of you come to class every day, and that's great. But the other ones, if you're online currently, if you could come to class, that would be much appreciated because I do use the feedback. Okay. Okay. Bonus points are coming to class. No, sorry. Do you know how much trouble? I'm not going to do it, but do you know what kind of that would look like? Come to class to do my evaluations, I'll give you bonus points. That's not a conflict of interest or anything. No, sorry, yes. So hopefully it's just worthwhile to come to hang out with people face-to-face once in a while. So Okay, so there's that on Wednesday. I'm going to send an announcement out about that as well, so you get a little reminder that way. So Chapter 12, this is what we're doing today. Chapter 12, we're talking about the statement of cash flows. So this is a statement we have not yet talked about much. We've done the income statement, we've done the balance sheet, the statement of stockholders' equity, and now we get to the statement of cash flows. The statement of cash flows is separate because I think it's a little more challenging than the other ones, but is potentially one of the most useful things for an investor to use. So, statement of cash flows, it reports, as you would think, where our cash comes from and where it goes. It covers a span of time, typically a year. So just like the income statement is for a year, for a quarter, same with the statement of cash flows. What happened to cash over the month, the quarter, the year? When we talk about cash, we're talking about cash and cash equivalents. So we're talking about not only coin and currency and checking accounts, but things like treasury bills, things that are cash, we could take them tomorrow and have cash for them. So cash equivalents are on this statement. Oh, I forgot to mention, I should have mentioned this. By the way, if you're online, Haley's typing a little slower today because she took a tumble over the weekend. Yeah, and she's got a sprained wrist. So she's still typing away, but no, she might be a little slower. And and you should feel sorry for her because she is quite bruised up, a lot of road rash. And she didn't even do anything exciting, so I'm probably embarrassing you. She just took a tumble hiking. So anyways, so let's see. So next, purpose of statement of cash flows. I'm guaranteeing you that the next slide coming up, well, let me make sure that my guarantee works. Okay, my next slide up is about this. Okay, my next slide up is going to say which of the following is not one of the purposes of the statement of cash flows. So statement of cash flows, what do we use it for? To help predict future cash flows, to determine our ability to pay dividends and interest, to evaluate management decisions, and to show the relationship of net income to cash. Those are all purposes of the statement of cash flows. So you probably want to make note of that because we are having a question coming up. The very next slide is going to say, which of the following is not one of the purposes? You know, they have the saying, cash is king. Well, more small businesses will fail due to lack of cash than lack of net income. Cash is really important to a company's health. So this statement is designed to show where the business is generating its cash from and where it's spending its cash. And we're going to break it down in different categories, so we'll see that as we come forward. But basically, we're looking at predicting future cash flows. Do we have enough money to pay dividends and interest in the future? How did the effect of management's decisions? Are we in a strong cash flow position? And then looking at net income to cash flows, which we'll get to. So the very next question coming up here, as promised, the statement of cash flows is designed to fulfill all the following purposes, except which one on that list was not on the list I just gave you. What? Okay. Okay, so learning catalytics, it's out there now, the question. The statement of cash flows is designed to fulfill all the following purposes except to what? Which one is not one of those purposes of the statement of cash flows? Okay, so statement of cash flows, which of the following is not one of the purposes? We're going to have about 10 more seconds on it. Numbers. This is pretty close. Okay. Okay, statement of cash flows has I'll answer the question in the chat room in just a second. Okay, the statement of cash flows doesn't have anything to do with assessing the collectability of accounts receivable, but the other things apply. The question in the chat room was this the one I had 100% on the early class? No, it was the first one. The first one we had a score of 100%, which was pretty exciting because we've never done that before. And we haven't done it yet in this class yet. So maybe next question. Let's see. Okay, so onward. Okay, so the first one objective went pretty quick, right? What's the statement for? Okay, next one objective says we've got 3 types of activities on the statement of cash flows. We are going to have, how many questions in total do we have today? Something like 10 or something. I don't know. I'm not. Something like 11. So we have a bunch of questions today. I would say 2/3 of them are on this right here. Okay? So what this right now is saying, we have to be able to identify what type of activity something is, a given transaction is. And on the statement of cash flows, activities are grouped into 3 buckets. And the first bucket is operating cash flows. Operating cash flows are what we get from operating our business. This is what generates net income for us. This has to, those are not minus signs, those are just dashes. So we have revenues, expenses, gains, and losses. Those all go together to create net income. And when we're talking about this category, we're actually talking about changes in current assets and current liabilities. Just make that note. Well, it'll kind of come together as we go forward. So operating cash flows basically have to do with changes in current assets and changes in current liabilities, but our operating cash flows come from our business activities. So this is what we're in business to do. This is how we make revenue. This is what expenses we generate to make those revenues. So operating cash flows are why we're in business. If you have these notes, I would circle operating cash flows. These are the single most important factor when evaluating the health of a company from a cash flow standpoint. So if you're looking at a statement of cash flows, the single biggest influence, the biggest factor when evaluating a business are going to be operating cash flows. So you know to put stars around that and put most important when evaluating. And you're going to see a question on this coming up in about 4 slides. So operating cash flows are the big money item. They're the ones, operating cash flows, if you look at a business, you want to see that the business is generating cash from its operations. If it isn't generating cash from its operations, it's going to be in trouble in the long run if it doesn't do that. Okay, so there's operating. So that's the big one, the one that we should be generating cash flows from. What are we in business to do? The next category is investing. Investing cash flows are cash flows related to long-term assets. Long-term assets are things like plant assets, property, plant, equipment. These are things like buildings, equipment, land, automobiles, investments, long-term investments. So anything in long-term assets is an investing cash flow. And then finally, our final category is financing. These are all the cash flows related to long-term liabilities and stockholders' equity or equity. So again, when we're talking about evaluating a business, the major one, most important one, is operating cash flows. Okay? So operating cash flows are the big ones. So when I think about this, if I'm looking at where my cash goes, where my cash comes from an operating standpoint, this is what I'm in business to do. My major thing where I generate revenue and pay expenses, I should be generating positive cash flows after the startup period. Of course, when you're in a startup mode, things are different. But if I have a mature company, I want to see that it's generating positive cash flows from its operations. Investing has to do with long-term assets. So these are things like buildings and land and equipment. I can generate cash flow from investing if I sell buildings, if I sell equipment, if I sell cars, if I sell long-term investments. And that's okay, but I can't rely on that long-term because eventually I will sell all my long-term assets and I will have nothing else. So it's not a permanent source of cash. And then you have to wonder, is the business contracting by selling all these things? So you see businesses, when they're in trouble, they start selling off assets to finance operations. Sears has been doing a lot of this, selling off assets in an effort to shore up the rest of its operations. Radio Shack did that. It divested itself of a lot of things too, trying to survive. But it's okay to sell an occasional asset, but you have to wonder if this is where all the cash is coming from. Financing section. Financing activities are things like I go and I issue stock. I go and I take out a new long-term loan. So if that's where I'm getting my money from, that's okay, but those sources will dry up over time too because people don't loan you unlimited amounts of money. But financing, I can also buy back my own stock, which is using money. I can retire, pay off long-term debt, and that's using it. So anything to do with long-term liabilities and owner's equity is a financing activity. So again, the big one for evaluating the health of the company is operating cash flows. I want to see that the company is generating adequate cash flows to survive. On Wednesday, we're going to look at some actual cash flow statements from companies to see what we see. Interestingly enough, Angie's List has been around something like 19 years. I think last year was the first year it actually had any positive cash flows from operations. It's been negative cash flows from operations for all those years, and it keeps getting cash from investing and financing. So you kind of have to wonder, yeah. And last year it was shaky too, so it'll be interesting this year to see if they get positive cash flows from operations. Okay. So anyways, this is another way, this is in your book. I just wanted to point out Exhibit 12-2, how these cash flows affect the balance sheet. If we're talking about current assets or current liabilities, those are both operating cash flows. They impact operating cash flows. Investing are long-term assets, and then financing is long-term liabilities and stockholders' equity. Okay. Now, so when we have a statement of cash flows, the statement of cash flows is organized by these activities. So first is operating activities, and next up is investing, and then finally financing. So we see the cash generated by operating cash flows, and then the cash provided by or used by investing, and the cash provided by or used by financing. So when we go to do our statement that operating cash flows, there's two ways to compute operating cash flows, okay? We're only going to do one, but I'm going to talk right now about both. So operating cash flows, there are two formats, indirect and direct, okay? The indirect method, which is the one that we are doing, the indirect method takes our net income, the net income that we have on our statement, and converts it to a cash flow net income. So our net income, we've already talked about, we do everything on an accrual basis because we need to account for things, we need to match revenues and expenses, etc. So for the statement of cash flows, we need to convert everything to cash. So the indirect method says, let's start with net income, make a bunch of adjustments, and then we'll come up with our net cash provided by operating activities. So what we have, and then the direct method does it completely different. So indirect, we reconcile net income to net cash. So we're starting with our accrual net income, converting it to a cash basis, net income basically. And to do this, in the lower left-hand corner of the box, we have net income, and then we have a bunch of adjustments. And we're going to go through those adjustments today. So that's what we're doing. The reason we're doing the indirect method in this class is because the indirect method is used by the vast majority of companies in the U.S. The vast majority of companies in the U.S., if you pick up their statement of cash flows, it's done using the indirect method. The indirect method and the direct method will come up with the same quote-unquote answer because the change to cash is the change to cash, but it presents it differently. So the indirect method says, let's start with our accrual basis net income and make all these adjustments to make it a cash basis. So now we're pretending, so let's assume that we use cash basis accounting the whole year. This is the cash net income we would have had, is the number we're trying to get. So there's a list of adjustments we make, and those are pretty well known. We do those adjustments, and it comes out. Okay? The direct method, on the other hand, says, no, let's do this. Let's just directly report how much cash we got from customers. Let's report how much cash we paid to suppliers. And let's just report those numbers, how much. The direct method, much easier for analysts to understand. Because you look at it and go, oh yeah, that makes sense. Look, I got 2,000 from customers. I paid 1,100 to suppliers, etc. Okay? Direct method, much easier to understand. But the problem is that most companies in the United States do not have information systems set up to capture the information you need for direct method. It would be extremely costly for them to convert to that. And knowledgeable investors know how to use the indirect method. So most companies in the U.S. do use the indirect method. That's what we're doing here. So you just need to know the direct method exists, but we're not covering it. It's Learning Objective 4. We are not covering it. We're doing everything we do, we're doing with the indirect method. International financial reporting standards only allow the direct method. So we're using indirect method, which is fine under U.S. GAAP. Internationally, you have to use direct. And again, most companies' information systems are not set up to capture the information for direct method. Okay, and we're going to go through those adjustments coming up here. Okay, but first we have a question. Okay, true-false question. Of the 3 types of business activities reported on a statement of cash flows, investing activities are the most important when evaluating a business. True or false? Okay, of the 3 types of business activities reported on a statement of cash flows, investing activities. Okay, a little bit ago we had listed all 3 types. I told you put stars around, circle one of them. This one's saying, are investing activities the most important when evaluating a business? True or false? We're going to close this in about 10 seconds to get your answer in. How are we in number? Okay. Okay, that is false. It's false because it's operating cash flows. So operating cash flows is what our focus should be in evaluating a company. Those operating cash flows are the most important. Okay, next up. So now we're on to the 3rd learning objective, and I guess this all kind of builds to preparing this statement. I'm going to show you some pictures in your some screenshots of pages in the book that are important. If you can't get to the page, I would urge you to download the PowerPoint because this is a lot of writing and it's a lot of templates to be able to use to refer to. So first up, on page 670 in your textbook is a statement of cash flows. Now I know it's too small to read, but I want to show you a bird's eye view. The statement of cash flows, at the top it has the company name followed by the statement name and then the date range. The statement of cash flows is for a period of time. So then what you see is the first section is the cash flows from operating activities, and then from investing, and then from financing. Again, we're taking a bird's eye view. Page 670 in your textbook, Exhibit 12.3, has this very nice template for the statement. And then down at the bottom, we end up with ending cash. So we have our operating activities cash, our investing activities cash, and our financing activities cash. So what we're going to do now is I'm going to blow up in large part of each section. Okay, so the cash flows from operating activities, again, look carefully at that. I'm going to have a slide that it's going to be a little easier to read because it's a little bigger with sharper contrast coming up. But again, page 670 in your textbook, this cash flows from operating activities always starts with net income. Remember we said we're doing the indirect method, so we always start with net income. That's our accrual basis net income, and then we have a whole series of adjustments. And that next line will say adjustments. We have a whole list of adjustments, and then we come up with our net cash provided by use by operating activities. So we have the total. So we're going to have net income, a whole slew of adjustments, and then a total net cash provided by operating activities. You'll see all of these we have provided by, which means it's a positive number. We also, in parentheses, it says used by. If this is a negative number, it'll be used by. So that implies, and you have to have a negative in your statement of cash flows, and we'll see some of that going forward. Okay, next statement will be investing activities. Again, page 670 in your textbook. This is a very nice template for everything that's on the statement. Cash flows from financing activities, and then what we end up doing is those three, operating, investing, and financing, we add those together and we add them to the beginning cash balance to come up with our ending cash balance. Okay, so now operating cash flows template. Right here, this is where the high contrast is. This is, you should know this, you should write it down. If you don't write it down, you can go back and get it later. The operating cash flow section, to me, is the most confusing part of this statement. It's hard to visualize why we're doing this. If I look at it, net income, okay, I can see that. Net income is this accrual basis net income, and then we're going to have a whole bunch of adjustments. These adjustments will always be like this. We always add depreciation. Why do we add depreciation to net income? Because depreciation is an expense. The reason we do is we're trying to make net income a cash basis net income. So we have to adjust for all the non-cash activity that went on. Depreciation is a non-cash activity, so we need to add it back because it had been subtracted. So we're going to add it back. Similarly, we're going to add back loss on sale of asset. Again, a loss on sale is a non-cash item. The actual sale of the long-term asset will show up in investing, but the loss is an accounting entry only. It's non-cash, so we add it back. The gain gets subtracted out. We have all these adjustments. The last four are some of the most confusing. The last four are increases and decreases in current assets and current liabilities. When I learned the statement of cash flows, this hands down was the hardest thing. Actually, in my accounting class, this is one of the hardest things I had because it doesn't make a lot of sense. At some point, the pieces will click into place, but initially you just have to do it. This template right here that we're looking at will be on the Exam 3 reference sheet. Okay, so you will not need to memorize this operating cash flows template. But we are going to have several questions in class today and Wednesday about it, so you'll need to refer to it. Okay, I'm not going to put the whole statement on the exam reference sheet, but I am going to put this portion of it on there. So you don't need to memorize, boy, I need to add back depreciation, I need to add the loss on sale, subtract the gain on sale, all of that. It feels backwards, so my best advice at this point is just go with it. You're going to have this, learn to refer to it. Okay, so you'll see we subtract increases in current assets other than cash. So any current asset we have, if it increased, we're going to subtract that increase. The reason we do this, let's take accounts receivable. If accounts receivable went up, that was a use of our cash. But if accounts receivable went down, that means customers paid us off. That provided cash. So you'll see down there that decreases in current assets. So like if accounts receivable falls, we add that back because that means customers paid us. So this is backing into this adjustment to a cash basis. So again, I would use this template. I would use this template when I'm answering questions in class here or preparing for the exam, the practice exam, but know that this template for operating cash flows will be on the exam reference sheet for you. Okay. Now, we're coming up on a whole bunch of questions, and I'm going to ask you about transactions, where they appear on the operating where they appear on the statement of cash flows. Your choices will be these three. It could be an operating activity, it could be an investing activity, or it could be a financing activity. So on your exam, on your homework, in class today and Wednesday, you need to be able to look at something and see where it shows up. So where it shows up depends on what it is. Operating, if it's a current asset or current liability, it affects operating cash flows. So you'll see that. If it's a long-term asset, it's an investing cash flow. If it's a long-term liability or an equity account, it's financing. To review, long-term assets, you should be able to take an account and say, oh, I know this is a long-term asset. A long-term asset is something like equipment, land, building, long-term investments. Those are all long-term assets. So if I ask you, you bought equipment, where does that appear on the statement of cash flows? Bought equipment? Equipment is a long-term asset, so it's going to be an investing cash flow. Okay. Then down on financing, long-term liability. Those are things like bonds payable, your mortgage payable. Equity accounts are things like common stock, treasury stock. Okay. So you need to be able to identify what kind of account it is, and that'll tell you what kind of cash flow it is. Okay, so got a whole bunch of these in a row here. So this right here, make sure you have taken note of it, because I'm not giving the answers to the questions that are coming up. So if you're sitting back waiting for me to give you the answers, not going to be on this one. So you're going to be able to have to take the question where I say, here's the item, which cash flow does it belong in? So operating are going to be your changes in current assets and current liabilities, things to do with net income. Investing is going to be your long-term assets, and then financing is going to be long-term liabilities and equity. Okay, so there was a question. Yes, treasury stock is a contra equity account, so it is classified as an equity account, and treasury stock would be financing. Okay, there's no long-term or short-term when it comes to equity accounts. Equity accounts are simply equity accounts. Okay, so let's get started with our first one. Okay, issuance of stock. So the company issues its own stock. It's reported on the statement of cash flows as a what? Operating, investing, or financing activity. Okay, so the question is going to stay on your devices. I'm going to leave it for a moment. Issuance of stock is reported on the statement of cash flows. This is issuing our own stock. So again, I would remind you, operating cash flows come from net income, come from changes in current assets, changes in current liabilities. Investing cash flows come from long-term assets. Long-term assets are things like building, equipment, land, long-term investments in other companies. Financing cash flows come from long-term liabilities, which are things like bonds payable, mortgages payable, and equity accounts, and our own equity accounts. So when we go back here to the question, issuance of stock, this is issuing our own stock. What kind of account is stock, and therefore what type of activity is this? Okay, on this one, 60% have it right at this moment. It is financing. It is financing, so good job to 60% of you. It is financing because issuing our own stock, if we go back here, our own stock, our stock in ourselves, okay, our own stock, when we issue our own stock, that is an equity account, okay? Equity accounts belong in the financing cash flow, okay? So the answer to this one, this first question that's out there is financing. We're going to close it in about 5 seconds or so. Okay, next one up. Again, before we get to it, I'm not going to give the answer on the next one. Again, operating cash flows have to do with changes in current assets and changes in current liabilities, net income like depreciation, investing, long-term assets. So if it's a long-term asset, it's an investing cash flow. If it has to do with a long-term liability or an equity account, think balance sheet, it is going to be financing. So let's do the next one here. Long-term borrowing, which is long-term debt, is reported on the statement of cash flows as what kind of activity? Operating, investing, or financing? Okay. Long-term borrowing, which is long-term debt, again, you want to refer back to what kind of account is long-term borrowing. Is it operating? Is it, where does it fall? Is it a current asset or liability? Is it a long-term asset? Is it long-term liabilities or equity? And that dictates whether it's operating, investing, or financing. So long-term borrowing, which is long-term debt, what kind of cash flow is it? Okay, long-term borrowing recorded on what kind of account is long-term borrowing? It's long-term debt, so where does it belong in the statement of cash flows? We're going to close this in about 10 seconds. That's a financing activity because it's a long-term liability. Okay, another one coming up. Again, reminder that operating has to do with net income, revenues, expenses, changes in current assets, changes in current liabilities. So that's operating. How I like to think of it when I'm answering these questions, I ask myself, is it a long-term asset? You know, equipment, land, building. If it's a long-term asset, it belongs in investing. And then I ask myself, is it a long-term liability or equity account? If so, it's financing. If it's not one of those two, then it's operating. Kind of how I back into it. Okay, next one. Purchase of land. And I just put with cash, that's not, so cash is just telling you this is a cash transaction. So purchase of land. Focus on land. What type of account is land, and therefore, where does it appear on the statement of cash flows? Operating, investing, or financing? So again, what type of account is land, and where does it appear on the statement of cash flows? We're going to close it in about 10 seconds. I didn't even look to see how far we are. Okay. That's investing. Land is a long-term asset. We have a few more. Okay, purchase of treasury stock reported on the statement of cash flows. So treasury stock. What kind of account is treasury stock? Remember, the treasury stock is our own stock that we buy back. We just looked at it a couple chapters ago. So again, the only transactions that impact operating are going to be net income, revenues, expenses, changes in current assets and current liabilities. Investing is long-term asset. Is treasury stock a long-term asset account? Where does it go on the balance sheet? Treasury stock shows up where? And then financing. Financing is long-term liabilities and equity accounts, stockholders' equity. Is treasury stock one of those? If it's one of those, then it's going to be a financing cash flow. So the big thing is, what kind of account is treasury stock? And this is where you see that knowing prior chapters has a big impact on later chapters. This is all cumulative, working up our way to this. So you have to determine what kind of account treasury stock is. I'll tell you right now, treasury stock is an equity account. It's a contra equity account, but it is still equity. So this is going to be an equity account. We're going to close this question in about 10 seconds. Learning Catalytics is always 50% accuracy and 50% participation. Okay, so we're going to close this. Okay, it's financing. Treasury stock, again, when we look at this, treasury stock, I told you treasury stock was an equity account. It has to be in the financing bucket, okay, if it's that kind of account. Okay, another one coming up here. Paying bonds payable. So bonds payable, zero in on bonds payable. Bonds payable, it's long-term. I will tell you that. So bonds payable, you always assume bonds are long-term. So what kind of account is long-term bonds payable? So again, going back here, looking at bonds payable, is bonds payable a current asset or current liability? Is it long-term asset, or is it a long-term liability or equity account? That determines what kind of cash flow it is. Okay, bonds payable, paying off bonds payable, reported as operating, investing, or financing. Bonds payable is a debt, okay? Bonds payable, payable means we owe it. So what type of account is it? We're going to close in about 10 seconds. Okay, it's financing because it's a long-term liability, bonds payable. Okay, so now we're going to do short exercise 12.5. And what we're doing in short exercise 12.5 is we're doing the operating section of the statement of cash flows. So Wednesday we'll do a whole statement of cash flows. Here we're just doing the operating section. We're using the indirect method and we're using that template. So when we talk about, oh, how do we do this exercise, how do we know we add or subtract something, we're going to refer to our template. So I'm referring to that template that I talked about earlier for the operating section on the statement of cash flows. So we're just going to dig in here and do the statement. It tells us a bunch of information about this company and balance, beginning balances, ending balances, net income, etc. So we're going to start by, we're going to prepare the operating section of the statement of cash flows. So this is the cash flows from operating activities. That's just the subsection that we're in. And the first item is net income. Whenever we prepare an operating section, first item is always going to be net income. And I'm getting these from using the template in the book. I can refer to page 670 in my textbook. That'll give me the template. I'm also going to include the template for this on the exam reference sheet for exam 3. So we're just going to be looking at that and saying, do we add or subtract this? There's a list of adjustments. So we're taking our net income, this is our accrual basis net income, and then we're going to have a series of adjustments of what we need to do to convert that net income to a cash figure. So net income given to us in the problem is $76,000. Next, we're going to have our adjustments. And that very long title, Adjustments to Reconcile Net Income to Net Cash Provided by Operating Activities. Wow, mouthful. It's just the list of adjustments. It's just a subheading. And our first adjustment is depreciation expense. Depreciation expense always going to be added back. It's a non-cash item, so it would have been deducted from revenues to get to net income, so we're adding it back. Because it's non-cash, we need to add it back. So we're going to add back depreciation expenses given to us. We're going to add back loss. How do I know to add back loss? Because it's on my template. I'm going to add it back. Loss is a non-cash item. The actual sale of the land will show up on the investing cash flow section because it's a long-term asset, but the loss itself appears as an adjustment in the operating section. Now, next up, we said changes in current assets, changes in current liabilities get added or subtracted. So what they gave us here is they told us at the end of the year that current assets were $59,000. At the beginning of the year, it was $56,000. So current assets increased by $3,000. So we are going to subtract the increase in current assets. Why do I subtract it? Because it's on my template as a subtraction. What's happening, if current assets go up, that uses cash. Cash is being used to finance the increase in current assets. So if we have an increase in current assets, we subtract that from net income. Next up, we have the liabilities. Liabilities went from $41,000 at the beginning of the year to $45,000. So we had an increase of $4,000. An increase in current liabilities gets added. And again, I refer to my template. It shows that I should add an increase in a current liability. And then I'm going to get a total. And I'm going to add my net income and add or subtract the adjustments as listed, and I come up with net cash provided by operating activities. If this number, this bottom number, were negative, it would be net cash used by, and it would have parentheses around it. Be careful when you're doing your homework. If you get a negative number, you have to show it, the total, as a negative, or it's wrong, because then it's used by. Okay, something I want to point out. If you were to be asked where depreciation shows up on the statement of cash flows, right here. See depreciation expense? Here, it's in the operating cash flow section. Depreciation expense always going to show up in operating cash flow section. It's an adjustment, okay? So that's how you do exercise 12.5. That is one piece of the statement of cash flows. This is the operating cash flow section. That's the most important cash flow when we're evaluating a company. We want to see that a company is generating positive cash after it's out of its startup mode. In startup mode, things are different. But if we have an ongoing company, we would want to see it's generating enough cash from its activities to survive. Okay, and depreciation shows up in the operating cash flow section, right? Depreciation shows up in the operating cash flow section. Okay, there's a question. Depreciation expense is reported on the statement of cash flows as what? Operating, investing, or financing? Again, to answer this one, look at the homework exercise we just did. What section of the statement of cash flows was that? You'll see depreciation on it. We're going to close this in about 10 seconds. Depreciation expense is a non-cash adjustment. We're good. Okay, now this next question, interest expense. Okay, interest expense this one's rather fuzzy. So interest expense is part of net income. So when you're asked where does it show up, it doesn't show up as its own line item. It shows up on the statement. So this question is in Learning Catalytics right now, and you do have to answer relatively quickly. Interest expense is on the statement of cash flows. We say that it's in the operating activities. It will not be a separate line. The reason we're saying it's there is it's included in net income. Okay, so it's just implied. This is a fuzzy question. Probably won't ask things that fuzzy, but you do want to get this answered. We're going to close it in about 10 seconds. Time is running out to answer. We are going to close it. Okay. Okay, so next up here. No, was that? That was it? No. We have one more. It's not the next one sequentially. Okay. Oh, I guess it is. Huh. There, I went right to it. Okay. This is our last question, but I want to talk about why this is the way it is. I didn't mean to go to the answer slide immediately, but there you go. Sale of equipment. When you go to determine what type, where this shows on the statement, you're always saying, is it a long-term asset? If it's a long-term asset, it is investing. Equipment is a long-term asset. So whenever you're asked one of these, what type of account is it? That'll tell you where it belongs on the statement. So equipment is a long-term asset. If this had said a long-term liability or equity, then it would be financing. If it had said a current asset, current liability, net income, something related to net income, then it would be operating. But basically, I asked myself, is it a long-term asset first? If so, it's investing like this one. Is it a long-term liability or equity? If so, then it's financing. And if it's neither one of those, then it's operating. So we're going to close this question. Yeah. And for those of you in the chat room saying that we didn't reveal the answer to you, sometimes we just, if I've got the answer on the screen, we don't need to reveal the answer to you. That's why it wouldn't be necessarily. Okay, so on this question, it's your final 5 seconds to answer to get credit for it. Activity has, okay, let's close it. Okay. Now the big thing in this chapter that, this chapter more than other chapters, you kind of have to practice a lot. Let's see, where did we have it? Okay, this page 570 in your textbook would be really good to have beside you when you're working on this. This is a really good template for the statement of cash flows. And what you can do is, in each section, I'm enlarging it now, so for that first section, it tells you what goes in that section. You have depreciation, loss, gain, increases and decreases in current liabilities. So it'll tell you. And then the next section, cash flows through investing activities. Again, this is page 670 in your textbook. It tells you the activities that are in this section. The activities in this section, sale of long-term assets like investments, land, building, equipment, etc., purchases of long-term assets, collections of note receivables, loans to others. That'll tell you. And then the final activity on this, it'll tell you what's in the financing activity. Okay. So those are the sections. I would urge you to have page 670 with you for Wednesday, because we're going to do a lot more of these types of questions. On Wednesday, I think our questions start saying, is it an increase or decrease in cash? So in addition to knowing which operating activity or which cash flow activity, you have to see if it increases or decreases cash. So it would be really helpful to have page 670 with you, or print out the PowerPoint slides that have these notes in them already. That will help a lot. But we're going to do more practice on Wednesday, but a lot of this is having it right beside you and practicing locating things. And we're going to do a full statement on Wednesday. Okay, so that brings us to the end of what we have for today. I don't want to go any further. I don't want to do a big statement today. I think this is a good stopping point.